If you look at this short-term high here, right before this low formed, when this high is taken out right there on that candle, that's significant. Only if this run down here has traded into sell stops, okay, below an old low of some kind. It could be a double bottom, it could be a single low, but it's got to be trading under some retail idea that would be viewed as support. Up here, the same thing. We're trading above highs. When this run above these relative equal highs happens right there, you're anticipating a market structure shift. See this swing low? Let me go back to this for a second. We have this high on this candle, then we have the candle right after that here, the highest one, and then the lower high of this candle here. So that's a swing high. Very simple little pattern, but it means a lot when it's in the proper context. When this high is broken with this particular candle right there, that is significant only on the basis that we have taken liquidity out of the marketplace. So when it broke this short-term high, this is more meaningful. And then the market will start to seek buy stops, okay, or buy side liquidity. That would rest above here, here, and here. All I'm going to do is add a few annotations, and this is about as extensive of lipstick we put on our chart. So here's those sell stops. So this little area here, that's a area where sell stops would be residing below that 14,600 level. The market dove into that liquidity, and you may or may not know that is a buy. You don't need to. You anticipate a shift in market structure. When the market rallies above, when does that happen? On this candle right here. See that little light bulb? That's when you're thinking, okay, now I have a condition in the marketplace that I might see an opportunity intraday. Short-term high is taken here. We traded above it. It does not need to close above that. Okay, real important. Once that candle closes and this candle opens, you're going to monitor this candle. And you want to see as soon as this candle closes, does it create that fair value gap? If it creates a fair value gap, again, that's a candle with a high, one single pass up. Next candle has a low that doesn't completely overlap all this. That's a fair value gap. Real simple, okay? This candle is where you would look to potentially trade at the earliest. The market trades down into that, boom, takes off. Here is insight. Order blocks, okay? I invented it. It's mine. No one talked about it before me. See these down close candles? That's all one continuous order block. What's it doing? It's inside that pool of liquidity, sell stops. Where's the open on that series of down close candles? Right here. That's the price level extended out in time. Boom. So inside this fair value gap, this opening price on the order block, that's your buy. Price starts to run where? Above the highs where buy stops will be here, above this high here, and above this high here. So the buy stops above here that was taken, this swing low forms once this candle closes. So this candle we're watching, does it go below that short-term low? It does. So now we have a shift in market structure that is now bearish, only because we've taken buy stop. Fair value gap forms, the market rallies up into that, you go short there. What are you looking for? Below here, sell stops. Below here, sell stops. Below here, sell stops. And in this fair value gap here. You can take partials below here. I really wouldn't do it there, but below here, here. And I know some of you are saying, well, why wouldn't you take them below their ICT? Well, if you're trying to get short here, that's not really that much movement. So if you're going to take something off your trade below that low, why not just try to reach for that one? And you could get it there, okay? And then below that low is nice as well. Below this low, and this is what I mentioned on the first lesson. This is below the 50 level of this high and that low, okay? So 50% level, that's what we're targeting. Now, this candle's low was the high end or first objective inside this gap. So that's your target. You're going to look for that. Here's that same price structure, just on a 1 minute chart. The same logic's still there, right? Swing high taken after liquidity's been traded into. This short-term high gets violated. Right when this trades down in here, what's actually occurring? High frequency algorithms are hammering. They're just throwing orders in. Buy, 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 buy. That is not, okay, here's an important thing. That is not causing the market to go higher. It's just volume that's coming in. The algorithms that deliver price, that offer price, they're constantly offering the price in the marketplace, that's what's beginning to spool and go higher. When the price starts to rally, all this is a default to the algorithm constantly offering price at a higher price. We're looking at the swing low right here. Market breaks down, trades back up into this fair value gap here, and sells off. And there's another fair value gap right there. Trades up into that as well. This is a 1 minute chart. So it's giving you multiple points of execution that you could trade on and then dives. See these two candles here? That's one consecutive bearish order block. The opening price extended out in time. Why is this a good bearish order block? Because it has that gap and it's taken liquidity and there's a market structure shift. There's your high frequency, high power, high probability bearish order block. What is an order block? What it is, it's a change in the state of delivery. The market's being offered higher, 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 higher in these two up-close candles. How did this series of up-close candles begin? With this candle's opening right there. Once this candle trades below it, that changes the state of delivery. So you go back to that point of reference right there, and that's why it's sensitive. The algorithm remembers that right there. Much in the same way, all of this movement down here, all these down closed candles, the opening on that candle starts this series of delivery on the downside. When that opening price gets violated here, it changes its state of delivery. Now it was offering sell side. When it goes above that opening, now it's offering buy side. What will it be doing after that? It will be looking for buy stops, buy stops, buy stops, because it's offering buy side liquidity. Same thing here. Buy side is being offered until that opening price is violated right there. Then the change of state of delivery occurs. Now the market's going to be doing what? Offering sell side liquidity. What's that mean? It's going to start going lower and attacking the sell stops, all the sell side liquidity. It's offering it to the marketplace. That's what's happening. That's what the algorithm is doing. But the market goes down to that 50% level. It's going down from a premium market relative to this low and this high. 50% is here. That's equilibrium. So it's going to go down to a discount. And that's that gap right in here. It doesn't look like a gap so much here. But if we go back up one more time, that's that single opening right there. On a 2-minute chart, and then on a 1-minute chart, it's 2 candles that make that up. But you're going to have to do is go through a progression of going from the 3-minute, 2-minute, and 1-minute chart, and you'll get your market structure and your areas of where it wants to look for an imbalance or old low or old high, and it just makes it easy. Swing high, broken. Market structure is now bullish. Rallies, taking buy stops, taking buy stops, taking buy stops. This right here, these highs right here, is just staying below that low. It's building up more interest that this is what? Resistance. That is engineering liquidity. Those individuals that know what you're learning today, they know that that's a pool of liquidity for buyers coming in at a high price. Why is that useful? Because smart money that bought down here, or here, or here, or here, or here, that's where they sell to high-seeking buyers. Look in here. You see that gap right there? See that down closed candle right there? That's your order block. Boom, buy it right there. What about this? Right here, dropping down. All these candles here are more significant if you look at it on a 2-minute chart. See that? It becomes one order block. Buy it, sell short, buy it again. We got up into the stops, sell short, reverse, then ride the larger swing down. So with that, I want you to think about how this is useful, okay? Number one, you're looking at London highs and lows, the session for London open. Okay, for instance, like 2 o'clock in the morning to 5 o'clock in the morning. New York time. Every time I tell you, just always set it with New York local time. 2 o'clock to 5 o'clock in the morning. That's your London session. What's the highs and lows of that session? Okay, that's important because the market's going to probably sweep above those highs or sweep below those lows and create situations like this. Okay, and the New York session is 7 o'clock in the morning to 10 o'clock in the morning, New York local time. Okay, what's the session high and low for that? And do the same thing for Asia. Okay, 7 p.m. to 9 p.m.